right, let's start. Good morning, good afternoon. Welcome to EDEC Infra webinar. I'm Natalia Gaidarenko, and I'm here with Darwin Marcelo, Project Director, Bertrand Giles, Senior Data Scientist, and Abhishek Gupta, who is Associate Director and Head of infraMetrics Product Development. This is our third session of the Green Inframonth webinar series, where we have been presenting the work we've done on climate impacts and risk. And today we will talk about extreme climate risk. The presentation will take about 40 to 45 minutes, followed by the Q&A session. Please leave your question in the Q&A section and they will be answered after the presentation. And now I hand over to Darwin Marcelo, the Project Director.
Thank you, Natalia. And thank you everyone for being with us today. Let me start telling you a little bit about infraMetrics by EDEC Infra. So first, infraMetrics has academic roots. infraMetrics is designed to produce analytics based on large and representative samples and using academically validated approaches rooted in modern financial theory and economics. Moreover, infraMetrics has been created on the foundation of over a decade of research and in unlisted infrastructure investment at the EDEC Business School. Currently, EDEC Infra provides market indices, benchmarks, and valuation analytics for investors in unlisted infrastructure, including equity and private debt, asset owners, managers, consultants, pension funds are currently using our data sets. Our metrics track thousands of investments in 25 countries over the past 20 years. More importantly, our key indices gain recognition from ESMA, the European Securities and Market Association. More recently, EDEC Infra embarked on a new ambitious project. We call it the Green Infrastructure Project, currently representing almost 3 years of work and several $1 million in research and development at EDEC Infra. The Green Infra Project has a dedicated team of data scientists, experts on infrastructure, sector experts, and climate risk experts. The climate risk and social risk metrics generated by the Green Infra Project are backed up by scientific research, quantitative analysis, and unique asset-level data sets. Now diving into the details of our climate risk infrastructure metrics, they quantify transition risk exposure, physical risk exposure, and it also includes estimation of extreme climate risk at the asset level. Our climate products are divided in 4 types of offerings. First, transition risk exposure metrics. This was the topic of the first webinar at the beginning of April. Then physical risk exposure metrics. This was the topic we introduced last week. Today, we're going to be talking about climate stress test metrics, and we're going to end this Green Infra Month with data for reporting. Finally, I want to emphasize that infraMetrics, our unique data and analytics platform, which includes the deepest available financial insights for unlisted infrastructure, will be now including these green infrastructure metrics that I just mentioned above. Right? Let me tell you a little bit about the speakers. With me, we have Bertrand, who is a senior data scientist and at the EDEC Infrastructure Institute. He holds degrees in theoretical and social physics and has published research on various topics, including collective behavior, decision-making, social psychology, resilience, complex networks, and behavioral economics. Abhishek Gupta is an associate director at the EDEC Infrastructure Institute, and he is currently the head of the infraMetrics product development. He has over a decade of experience in asset management and alternative investments, including stints at Goldman Sachs and Partners Group. Finally, my name is Darwin Marcelo. I'm the project director of the Green Infrastructure Project. Before, I was the program manager of the World Bank Quality Infrastructure Partnership, And I was also the lead of the Global Infrastructure Connectivity Alliance. Now, I'm going to leave you with my colleague Bertrand, who's going to be walking you through the work he has done on climate scenarios. Bertrand.
Thank you, Darwin. I think now you should be able to see the next slide. So thank you, everybody, for being here. Today, I will show you the work that we have done with my colleagues Abhishek and also Frédéric Blanc-Brud and Tim Whitaker on how to include climate risk into the valuation of assets. So I will present to you the metrics that Darwin mentioned. I will share a bit with you the methods that we use, the data that we have. And then in the second part, my colleague Abhishek will take over and show you how we can use actually these metrics for your assessment at company level or your portfolio. Okay, so this is how the website looked like. You probably have seen something similar in the previous webinars. So you can find market indices and benchmark, as Darwin said. You also can find all our papers in which we describe in detail everything that we do, the methods, also the data. And you can see here in the center, this asset search and due diligence. Then you can find also the metrics that we have. We will share in the end where you can find this website. Okay, very importantly, at EDEC Infra, we base our work on a classification of sectors that is called TICS, that has been peer reviewed by the industry. And that classifies sectors across 8 what we call superclasses, industrial superclasses. So it could be transport, network utilities, data infrastructure, for instance, and that are subdivided into 101 industrial asset subclasses. And at EDEC Infra, so in the infraMetrics platform, we cover over 700 assets across all of these sectors. So we have very diversified a set of data that is very representative and all over the world as well. Okay, so now let me share a bit more about the extreme climate risk metrics. So first, a bit of clarification of what we call climate risks. So usually we classify them into 2 categories. The physical risk corresponds to everything that is related to damages that can occur after an event, a hazard event has occurred. So you would have floods, fires, earthquakes. That has a certain probability of creating a damage on your assets, right? And we need to take that into account, and that's what we call physical risk. On the other hand, you would have what we call transition risk, which is more the cost and losses that will occur following a new policy that will be integrated in order to fight climate change. So typically, a carbon tax will increase the price of carbon that will have an impact on how you run a company. Okay. And of course, this will have an impact on the prices of your assets. So this can impact the cash flows. So the revenues can be lower, the cost can increase, or the dividend can be lowered as well. The risk premia and discount rate also will be impacted by these climate risks. So it's very important to have a model to understand and be able to project what can happen across different possible scenarios. And that's where it comes from, the NGFS scenario that are at the basis of our work. So NGFS stands for Network for Greening the Financial System. So this is a set of 6 scenarios that are the reference in the financial sector. And the scenario provides different narratives of what could happen potentially in the future. So there are benchmarks telling you, okay, if we do this kind of effort in order to mitigate climate change, here's what's going to happen to, let's say, GDP, inflation, and other kind of variables. If we don't do that, here's what's going to happen. Okay. So usually these scenarios are actually divided into 3 categories with 2 scenarios per category. The first category being orderly scenarios, which represent the best case, so it's what happens if we do everything as we should do. So we start acting today by putting policies from now on in order to fight climate change. So there are 2 types of scenarios. The net zero one is a bit more stringent because the goal is to reach 0 emission by 2050, whereas the other one, below 2 degrees, has as a goal to remain below 2 degrees increase, above pre-industrial levels at the end of the century. So the policies can be introduced more gradually. So in both these scenarios, there is not a lot of physical risk because we mitigate climate change, and we don't have a lot of transition risk because we can include policies softly from now on. Then the disorderly scenarios, We also mitigate climate change, so we do what we should do, but we do it either too late, so that would be the delayed transition scenario. So we start putting policies in 2030 only. And divergent net zero is when we do things, but in a disorganized manner. So in both cases, to compensate the fact that we don't do it the right away and in the right way, we will have to put stronger policies. Okay, so the transition risk will be higher, but not the physical risk, because we still mitigate climate change. And finally, the hothouse world scenarios. In these ones, there is not a lot of transition risk, because we don't put a lot of pressure onto the companies to change the way they use fossil fuels, for instance. So current policies, actually, we just remain as we are now, no new climate policies, and naturally determined contributions is countries just do wherever they want, whenever they want. Okay, so in both cases, not a lot of transition risk, but of course the temperature will reach 2.6 or 3 degrees above pre-industrial levels. So there is a high physical risk. Okay, so at this point, we would like to ask you a question. So we have a poll here that should appear on your screen. And we'll be very interested in knowing your answer to this question. So you will have 30 seconds to answer. Okay, please 10 more seconds, and then we have to stop. Okay, so we can stop now. Okay, so I think you are seeing the results. So this is roughly distributed. This is very interesting. This is roughly distributed between we use NGFS scenarios and we don't do climatic assessments. So actually, for those who do climatic assessments, so you know it makes sense that you use NGFS scenarios because they are the reference. So that's why we also use them. And it's interesting to see that also some people do not do climatic assessment, which is the point of this conference today, of this webinar, is to show you that it's actually very important. It can have a very strong impact. And so I hope we will convince you of this by the end of the webinar. So thank you very much. Now I will continue. Okay, let's do this. All right. Okay, so now let me give you more detail on the extreme climate risk metrics that we have built. So something that we want to know is the value of the company, how it will evolve in the future according to different scenarios or following different scenarios. So here we take an example of a Spanish toll road, and we show you two lines. So the red line here on top is what happens, what is predicted to happen in the orderly scenario. So if we do everything right, this company will still continue to have a valuation that is more or less stable and even slightly increase over time on average. Whereas you can see that in the purple line, in the disorderly scenario, you will have a sharp decrease. So there is a very strong impact occurring around 2030. This is the delayed transition scenario. And this will, of course, impact strongly the price of the assets. Okay, so that being said, to calculate the valuation, one very important factor is discount rates, which represent the risk in the future cash flows of your company. And we can, from the data that we have, we can project this discount rate in any scenario up to 2050. So then we calculate the valuation. And then from these two lines, we have an interesting metric, which is the relative difference between the two. So this gives you an intuition of the impact of not doing the right thing, right? So this orange dashed line here shows you the relative difference between the disorderly scenario as compared to the orderly scenario. And you see in particular this sharp decrease around 2013. And so this metric, we call it extreme loss, and we have a value at any point in time. And so here, I give you as an example, I show you as an example here. In 2050, you see that the value at the extreme loss of the company is -22. So the company is at risk of losing 22% of its value in 2050, and we could do that for any point in the line. But then there is also another metric that is interesting when you see this, which we call maximum drawdown, which is not only the value at a specific point but the expectation of what would be the worst or the biggest, the maximum loss over a certain period. So here's by still taking 2015, this time I don't look at the value in 2015, but over the whole period between 2022 and 2015. And you see that the maximum loss, so the minimum value here is about minus 35. So the company has a maximum drawdown of 35%. Okay, now that I clarified the metrics, let me tell you more about the methods that we used and the data that we have. So the models are based on first relationships between key financial variables, so the revenues, total asset, and OPEX in particular, together with macro variable, GDP and inflation. The equation that we use are recursive, meaning that the variables at time t depend on the same or other variables at t-1. So we can then project this equation and we can project values of the financials up to 2050, so long as we include the climate risk from NGFS. Once we have this projection, we can put them into our asset pricing model and we get projection of equity risk premia, discount rates, revenue, dividend, and prices. And then when we have this time series of these variables, then we can calculate the metric that I just presented in the previous slides. The data that we have, so for the historical data, we use financial data from infraMetrics. So as Darwin mentioned, this is a unique database of over 750 companies across the world and covering all sectors. We have the climate risk data, which have been presented in the previous webinars 2 weeks ago and last week. So the CO2 emissions for all scopes and the damage factors, which represent the physical risks. Then for the historical macroeconomic data, we use the World Bank. So we take the GDP and inflation from there. And for everything that is projection into the future, we use NGFS that I presented earlier. So we cover 25 countries across Europe, the Americas, and Asia Pacific, and all the sectors. Okay, now let me give you a more visual understanding of or intuition of how the model works. So first, we use relationship between these financial variables, total assets, revenues, OPEX, and total debt, and macroeconomic variables, GDP and inflation. And you see that the central equation is actually on total assets, who has GDP and inflation as input, and then total asset is used in the equations of revenues, OPEX, and total debt. And then when we want to project those into the future by taking into account climate risk, we use NGFS. So the GDP and inflation, we will have values of every year until 2050 in each of the 6 scenarios. And NIGEM is a macroeconomic model, actually the leading macroeconomic model from which they calculate, NGFS calculates macroeconomic variables. Then the carbon tax and electricity price is also taken from NGFS, and that has a direct impact per scenario on the price of Scope 1 and Scope 2 emissions, which will be counted as operating expenses. And finally, the climate risks, the physical risks, which consist of damages, potential damages. So total assets are impacted. We need to account for that, to plan for that in the future. So we need investments, which will be counted into the total debt. And when we have a damage, we need to repair or to replace. So that will be counted as operating expenses. Okay, so just a few words about the physical and transition risks as a reminder. So we have dedicated teams at EDEC Infra working on them. So 2 weeks ago, my colleagues Fabien Hugier and Darwin Marcello presented how to estimate Scope 1, 2, and 3 emissions. And last week, my colleagues Etienne Hugo and Darwin Marcello presented how to estimate the physical risk, so damage factors. So an intuition of what it actually means, this risk. So physical risk represent what happens when temperature increases. You would expect that you have more frequent hazards and more dangerous. Okay, so more expected damages, that would be a cost for a company. So that's mostly happening in the scenarios in which we do not act to mitigate climate change. So the hothouse work scenarios in particular. Whereas on the opposite side, if we do act against climate change, so we can mitigate it, we will have to impose measures such as carbon tax or incentives to change the energy mix. And this will have also a cost. Okay, so this is transition risks. Okay, and in particular, the increase in the price of carbon and electricity. The details of how this, of the methods to calculate and estimate the emissions and the physical risks are detailed in these papers that are available on the platform. And now I will hand it over to my colleague Abhishek for the second part, in which he will show you the methods for evaluating the assets, and start with the poll number 2. Thank you very much.
Thank you, Bertrand. Natalia, can you please launch the second poll question? Yeah, so we are asking you a question here based on what Bertrand had explained about physical and transition risks. We're trying to assess which risks are more important when you are looking at climate assessment, climate risk assessment. It's possible that both are equally important, none of them are important, but we just wanted to get your take on this and then show you some of our findings later on in the second part of the presentation. All right, a few more responses, maybe 5 more seconds. All right, I think, Natalia, we can stop the poll and share the results. But this is quite interesting. The majority of the people say that they consider them equally important, and probably I would have voted the same. I think they are equally important, but I think the difference that we see is that physical risk is more of an idiosyncratic risk in nature, that it may not affect all the assets to the same level and against the same level of risks, whereas transition risk is something that can have a more systematic, widespread impact. It can affect the whole macroeconomic environment. And that's what we want to cover a little in the second part of the presentation and show you some of the results that we have found. Right. So continuing with the methodology first, I wanted to talk to you about how we value infrastructure companies a little, give you a bit of background, and show you how we look at the valuation differences, the approach that we have taken to do this. So first, the key point that we are trying to do is look at the valuation difference between different NGFS scenarios. So that we can assess the impact of one scenario versus the other, how much you are exposed to the risk, and what it could mean for your investments. And for this, we want to address 2 important concepts: the duration and convexity of infrastructure investments. It is quite important in this asset class because infrastructure has long life and quite often it's finite in the case of project financed companies, and more or less stable cash flows that are well predictable in advance. So these properties are very much like fixed income asset class, and they make duration and convexity concepts quite important. So the way it works is that infrastructure companies, they can have quite different duration and convexity, even though they may have the same yield, same total amount of cash flows during the life that they're going to distribute, and so on. For example, if future dividends are steady, the convexity will be lower. But if leverage is high and it constrains the dividends in the early part of the life of the company, more dividends will be received later on, and that will make convexity and duration both quite high. Just to illustrate this with an example, there are 3 cash flow series here on this plot. One is quite consistent, and it pays the same amount of cash throughout its life. The other is a bit more dramatic. There are some cash flows, but inconsistent throughout the life. And the third is completely erratic. We have one huge cash flow at the beginning, then 3 more cash flows towards the end of the life. The point is that if you do a nominal sum or yield or maturity, all the 3 cash flow streams are the same. There's no difference in them. But the convexity can be almost double for the third cash flow stream. So this is a fundamental concept in fixed income world, but we are trying to leverage on this when we are thinking about valuations in infrastructure. Continuing the subject, I'm sure a lot of you would be familiar with this equation. This is the way the price changes or price sensitivity is approximated in the fixed income world, knowing how much yield can change, or a given change in yield, how much impact can it have on the prices. So this term here, delta V over V, is the percentage change, percentage difference in the valuation of the asset. This part is the duration effect, and this is the convexity adjustment. The key thing to note is for duration and convexity, we use scenario-specific cash flows because, like Bertrand mentioned, the revenues are different, debt is different in different scenarios, etc. Consequently, the dividends will also be different in different scenarios, and that would lead to significantly different duration and convexity. And the other key thing here is the discount rate, which is obviously different because you have different interest rates, different equity risk premia as a result of leverage, profits, etc., which is quite different. So this delta Y is the one that we want to focus a lot more, because that's the tricky concept, and we want to address this a little, how we estimate equity risk premium or discount rate in infrastructure companies. For this, we rely on the EDIC asset pricing model. This model is used for all of our valuation approaches. It's a fair valuation technique. And the way this works is that we look at the observed transactions in the market. Based on those observed transactions, we extract the expected returns and decompose them into a few risk factors. The rationale being that if you have 5 observed transactions or 10 or 50, doesn't matter, all those companies are exposed to some risk factors. These are size, leverage, profitability, investment, term spread, and some controls. We have found these factors after years of academic research, understanding the robustness of the models, etc. But these 5 factors are found to be explaining these expected returns quite well. Now, if we can do this for the observed transactions, then we can find out how much market is pricing each of those factors right now. So what is the price of leverage according to the market? And now, having known these factor prices, we can apply these loadings for any company in a universe. So if we have an airport, toll road that hasn't traded in the market for a while, but we still know what is the leverage of that airport, what is the profitability, size, etc., we can apply those loadings and find the equity risk premium that the market is suggesting for that company. And similarly, we can do that for the 750 plus companies that we have in infraMetrics. So the approach is very robust, and we have been testing it thoroughly, using it in all of infraMetrics products. But the way we implement this approach here is that with NGFS scenarios, we link climate risk inputs. So the inputs around how much is the physical damage possible, how much is the transition risk possible because of GDP inflation forecast in different NGFS scenarios, we link them to what can happen to leverage profitability investment of these assets. And through these established links, we can create a forecast of each of those factors. So for the same airport, there is certain leverage today, but how this leverage can change depending on whether you are in an orderly transition scenario, disorderly, or hothouse world, what's happening to that company. And second, these factor prices. So we don't know what these factor prices are going to be in the future, but what we do is we look at a long-term average of these factor prices, historically, assuming there will be some kind of mean reversion in those factor prices, and that would lead to a robust forecast for the future. We do these 2 inputs, we can essentially forecast a discount rate or equity risk premium for any company in our database. Now, having understood this methodology briefly, I wanted to show you how you can use this data for, first of all, the assessment of individual investments, individual companies. So the one thing that we have found is that an obvious question is, if you have to compare 2 investments by their extreme climate risk, you have invested in 2 toll roads, for example, and you want to compare, which one has more risk, how does it compare against the rest of the market? And here, this data can be quite helpful. So we are showing you 2 toll roads here. One is in Spain, one is in France, and we are comparing them against the global road segment in infraMetrics. They are quite different in terms of the financial metrics, even though they have the same contractual life remaining, almost same contractual life remaining. They are quite different in terms of their financial metrics. The Spanish toll road has a very small size. The French toll road is quite large in comparison. And also in terms of leverage and profitability, they are quite different. And similarly, in the climate risk exposure, so emissions, the Spanish road is small, and probably that's why, or because of less traffic or whatever the reason be, it has fewer emissions, much fewer, about 6 times less than, 6 to 7 times less than the French one. Similarly, the physical damage at risk is almost the same, but a bit more in this Spanish toll road. So all these factors, the financial factors, the climate factors, they will have an impact on the extreme climate risk that these companies are exposed to. And that's what we are trying to assess. Now, if we look at the financial projections of these two companies in different climate scenarios, we have taken three scenarios here. Net zero 2050, which is an orderly transition scenario, delayed transition, and current policies. If you look at revenues, the autoroute A28, it has 10 times higher revenues and 3 times higher debt than the Spanish toll road Autopista Central. And that's a finding because of we have forecasted GDP and inflation in these scenarios and linked to these financials. We have found that the French toll road autoroute A28, it will grow a lot more. It will have much higher revenues. And also it may require a lot more investment in comparison because it's an orderly transition scenario. Profits are 3 points higher and become much negative later on. So that's something that we have compared between these two companies, that autoroute A28, it will have much higher profits as compared to the Spanish toll roads, but they will turn a bit negative in both the cases. Revenues and debt levels are higher in orderly transition scenarios. And that's something from the intuition as well, that orderly transition requires investment, as well as if done successfully, it should lead to higher revenues. And that's one of the forecasts from our results. And profits decrease the fastest in hothouse world scenario. So you can imagine, where there is no order, nothing whatsoever, the profits will be much lower in both the cases, both the toll roads. These financials directly result in discount rate of these two companies. So we have compared two scenarios here, net zero 2050 and delayed transition scenario. We have the two toll roads and compared against the global road segment. The first conclusion here is that in the net zero 2050 scenario, both companies have higher discount rates than the global average of toll roads, at least until 2050. And that's because of lower profits. They both have lower profits than the global average. Second finding is in the delayed transition scenario, discount rates are much higher as compared to net zero 2050 scenario. And that's sort of expected as well, especially the jump that we showed you initially in the first part in 2030. That's when the delayed transition happens. So the discount rates spike up quite sharply, and they are much higher than 12% in the delayed transition. In both scenarios, Autopista Central is expected to have a higher discount rate, almost always throughout the life, at least until 2050 that we have valued these two companies. And that's due to its higher leverage and lower profit forecast. Now, all this can be used to compare the extreme climate risk and maximum drawdown metrics that we talked about initially, and we can compare them against the global road segment. So if you want to, again, rank these companies, first you have to pick a horizon, what horizon you are interested in. Then these are the two metrics that we provide you to assess which company is doing better in terms of risk. So by 2030, both companies are expected to suffer a higher extreme loss as compared to the global roads. A28 will have a larger loss, but a smaller max drawdown. That is, by 2030, the French toll road, autoroute A28, it's going to have 2.7% of extreme loss. So that's much higher than the global average and also higher than the Spanish road. But the maximum drawdown is the lowest of the three. So the valuation difference is quite consistent in terms of the French toll road. There are no sharp drops, as you may expect in the Spanish toll road case. At some point, it would have lost 8%, but some of that recovers by 2030. And secondly, the Autopista Central, the Spanish toll road, it has a much higher climate risk, no matter which horizon you look at. By 2040, 2050, it has a much higher climate risk than the French road or the global average. So obviously, if you were to rank these two companies, it's clear that your Spanish toll road, Autopista Central, has much higher climate risk than the global average or the French road. You can do this comparison directly against individual companies. So in infraMetrics, we produce asset level data, and it would show that these two companies, the toll roads that we are looking at, their average, their maximum drawdown and extreme loss is in line with rest of the toll roads. It's quite in line with the global average. But also you can assess some other companies in our database. So these toll roads here highlighted, they have a much higher maximum drawdown. That's about 3 times larger than the extreme loss. So at one point, there's a risk of losing quite a lot of the value, even though by 2030, a lot of that value may recover. And these companies here, they have no risk in 2030. So by 2030, almost all of their risk has disappeared. The valuations are more or less in line between orderly and disorderly transitions. But at some point until 2030, they are exposed to a large loss. They could lose up to 10 to 15% of their value. So these kind of analysis is possible if we look at the asset level data within that sector, compare against the global road segment. That brings me to use case 2, how you could use this data to assess the portfolio as a whole. So you can think about building a proxy for your portfolio using infraMetrics data. Now, if you are exposed to a few sectors, you may want to consider how can I assess the risk of those sectors. So in infraMetrics, we give you the sector by sector exposure. So both these metrics, extreme loss and maximum drawdown, are available for all these industry classes that we talked about. And you can look at the distribution of climate risk in each of them to make an assessment of your portfolio. If you are exposed to more transport sector, you can look at our data and use that as a proxy for your transport portfolio. Some of the key findings from this data that we have seen is in power generation and energy companies, so more oil and gas type companies, we have high climate risk. So that's nothing unusual. They have higher mean, higher median, higher quartiles. So the whole distribution is shifted towards right, as you can see. And in the social infrastructure and renewable power sector, so which are more conservative, typically low risk, and they have less transition risk, importantly, they have lower risk in compared to other sectors. But they still have some risk, and that's the key part. That's what I was talking about initially with the transition risk, that it has a widespread impact on the macroeconomic factors. If your transition is not properly done or whatever scenario you are in, it will lead to higher interest rates, higher different inflation scenarios, etc. And that changes all the sectors, no matter whether they are exposed to transition risk directly or not. Finally, you can estimate the climate risk of your portfolio or any part of it using some or different combinations of these segments. And that's how you can build a proxy for your portfolio. The other thing you can do is look at any of our market indices in infraMetrics, for example, Infra 300 or a debt index like Infra 100 Global, and you can adopt these as one of the benchmarks for your portfolio. So if your allocation is in line, your strategy is in line, you can adopt any of these indices as the official benchmark, and then use these benchmarks to estimate a climate risk for your portfolio. So example, in Infra 300, by 2040 horizon, you have an extreme climate risk of 18.8%, maximum drawdown of 27%, and that can be used as the proxy for your portfolio. So if you were to use Infra 300 index, you can not only proxy the financial performance, but also this climate risk. And that's quite powerful because you will get both sort of assessment through the same representative benchmark. So that brings me to the end of this presentation. And now I just wanted to show you quickly how you can access infraMetrics. So if you can go to our website here, EDEC Infrastructure Institute, and you can request access to the platform through here. And that will send a note to our team and they'll be in touch with you to guide you through the next steps. And that's it. Thank you from my side.
Thank you, Abhishek, and thank you.
Should we address some questions now? Yeah.
Yeah. Thank you, Abhishek. Thank you, Bertrand, for the very interesting presentation. Yeah, we have a number of questions, and considering that we still have some time, I'm going to read some of these questions for you to answer, for the panelists to answer. And the ones that we don't have time to answer anyways, we send an answer via email. So let me start with the first question. What is the advantage of the NGFS scenarios relative to the climate scenarios produced by other organizations?
Okay, I can take this one. So clearly, because they have been generated to answer a financial institution to help them, assess climate risks. When we're working in the financial sector, definitely these are the reference. These are the absolute scenario, reference scenarios in the financial sector. So that's why they make sense, and that's why we also saw that many of the attendees here use it as well.
Thank you, Bertrand. Related to this question and the inputs that you've been using for the models, are the damage factors generic or asset specific? And related to that question, do you consider climate adaptation and resilience in your projections of physical risks?
Okay, so yeah, the damage factors, they are asset specific and also risk specific. So we consider several risks. For now, we have floods, storms, cyclones, and we will include more risks. So they are actually quite specific. And for the second question, so for now, so resilience is not included as a part of this damage factors. We have it in mind for sure, but it will be more included into something that we will include into the model as a behavioral reaction or something of the people. These damage factors, they are calculated as of today. So this is just a number, and then we project them by estimating from the literature what would be the increase, for instance, in flood, by the expected increase in flood by 2050 or 2100, and then we can generate an expected growth in the risk. So this is just a number calculated as of today, but the resilience itself, yes, we have it in mind. So that would be included probably in a version 2 of the model in the future, but that would be, yes, at the model level.
Very good, very good. Would it be possible for you to give us an example how this data should be used to do risk management?
Yeah, I mean, probably I can take that. I think we've shown a couple of cases, but in general, what we have discussed with clients and prospects so far is that these sort of climate risks are used as a criteria for exclusion or inclusion in the investment strategy. But with these objective measures of extreme risk, what we are trying to get to is a more concrete step in the investment strategy, that you start to compare them like a financial risk. You start to look at the climate risk of the whole portfolio, whole strategy as a whole, whether be it at the asset level of the strategy or for the whole portfolio. But you can think about it on a regular basis, monitor it properly, and then set some thresholds that this is the threshold that you want to meet, not exceed this, and so on. Just like any other financial risk. That's what we are getting at with these metrics.
Very good. Regarding the second part, why is there less difference between scenarios in profitability as compared with other variables?
Okay, so this one, there is a mechanical component in the answer. So in the model, if I'm not even in the model, the definition of profitability is the difference between revenues and operating expenses, so that we would call earnings, divided by total assets, so the size of the company. So actually, because I mentioned that total assets are a central equation in the model, and it is used as a regressor in the equations for revenues and operating expenses, then quite mechanically, let's say a difference between scenarios in total assets would be more or less reflected also in revenues and OPEX. So that's why also, at least in this example that we showed, because it's just one asset, but we have also many assets across many sectors. So this is not always the case, because the curve don't look always like this, but this is a typical example. That's because actually the difference would be reflected in all three variables, and that would cancel out. So there is less difference than in other variables individually taken. And yeah, think I don't know, Abhishek, if you added something, but that's
yeah. I think in addition, if I can add, I think there is still difference between say hothouse world and orderly scenario in profitability, and that's because profitability is a function of how much investment you have to make, how much damages you have to repair, and so on. And hothouse world is more exposed to physical risk, and that's why it may have a larger impact on the profitability. And there is still some difference in our forecast.
Thank you. In use case 1, I guess Abhishek, you mentioned that there was, or you showed that there's a line of assets with zero extreme loss in 2030. What are they, and how come zero extreme loss is possible?
Yeah, so that's the thing, because the way interest rates evolve, the way equity risk premium evolve between different scenarios by 2030, there is small difference. And that's why the losses have come down. At least the estimated loss between scenarios is much smaller, almost zero. But during that process, until that horizon by 2030, we expect some drawdowns. So that's why I was stressing on the fact that during that period, it's not that there is no loss. It's just that by 2030, those valuations have recovered. And that's why it perceives that now there is no difference in the valuations, but there could be up to 10 to 15% loss exposure during that horizon.
Thank you. And related to that, why do renewable power companies also have some climate risk? What
yes,
kind of...
That's the transition risk element. So I touched upon it briefly in the slides as well. I think with transition risk, we are talking about a change in the macroeconomic environment. So while renewable power companies are not directly exposed to climate transition, but because the way interest rates move, inflation moves, etc., all the companies can have a hit on their valuation. And that's what we saw in renewable power sector as well. Now, they may not be as impacted, and that's why the risk is much lower as compared to other sectors, but there is still some risk to their valuations, and investors need to be aware of that.
Very good. On the box plots that you presented, Avi, which method you use to estimate those distributions?
Right, so we are looking at a 2040 horizon for those box plots, and within each sector, we are showing you a distribution of all the companies that we have in our database, and 2 metrics for them. One is the extreme loss metric, one is the maximum drawdown metric by 2040, and to show that in some cases, while extreme loss is smaller, they are still very much in line, the 2 metrics. So the losses are quite high, even though you are looking at a long horizon.
Very good. Now, regarding the toll road example you presented, you presented absolute emissions, which seems to be a factor rather than an emission intensity. What do you have to say around that? Because of course you also produce carbon intensity metrics, but in the example that you have the absolute emissions rather than intensity metric. Is there a reason for that, or just as an example?
I think we use emissions directly in the model, but don't correct me if I'm wrong, but emissions are directly used instead of an intensity because it impacts how much, it's a model, it's a statistical model, so it relates to how much total assets can be impacted because of the emissions.
Yeah. Related to that question, in the models, it's mentioned auto-regression model, right? And also we're presenting some linear equations between the quantities. Is it enough to consider a linear model? I would have expected non-linearities describing better this behavior. What do you have to comment on this?
So, okay, very good point. So first, something I didn't mention because I went to the general headlines, but it's not entirely linear. It's linear once you have applied some logs first. So we do the log actually. And also why we ended up doing linear maybe for all factors is because we tried also different things. What happened when you do a square, what is the best regression that you get? Actually, linear was, at least as good as the rest. So then principle of parsimony, if there is no big reason to use a square anywhere, we use the simplest case, but these are logs actually that we use.
Thank you very much. I think we can take one final question. I guess this maybe for the second part of the presentation. What could cause a rebound of valuations of assets heavily exposed to climate risk?
It's not so much the rebound of the valuation themselves, it's the spread between the scenarios that has narrowed down. So the way we are measuring risk is how much is the difference in orderly valuations versus disorderly valuation. But ultimately, if you think that these 6 are all the scenarios possible, you have to be in one of them. So your risk is whether you are in the best one or in one of the worst ones. Now, if that spread becomes small, that's what we call low risk. So it's not the valuations themselves, they may have rebounded, but because the way delayed transition happened, the discount rates evolved, etc., the profitability of the company is forecasted to change. It may lead to such case that the spreads are small between different scenarios.
Thank you very much. I guess we've reached the end of the webinar. Bertrand, Abhishek, again, thank you very much for the presentation, and thank you everyone for your participation and very interesting questions. We invite you to join us to the next webinar, how to use infraMetrics in sustainability reporting, and we hope to see you soon. Thank you, everyone.